We had a fairly red day in the market yesterday, but that doesn't change the fact that companies continue to be significantly overvalued, trading well above even their own historical levels, and that's also the same conclusion when we look at it on a price to earnings growth. Even companies with massive growth projections are also still looking overvalued, and you could argue that the news that trade negotiations are going very well, that a deal is very close between China and US, was already priced into the market, and perhaps over the upcoming days or weeks we could start to see the S&P cool off a little bit, but nonetheless investors still maintain greed, they're still buying, investor sentiment very high, retail continue to buy any dip or in fact just on a daily basis. Now today's episode we really want to focus on companies that are either in the semiconductor value chain or are affected by it one way or another, and we're not just going to look at the typical companies like Nvidia, which has done very well, not over the last year, where whilst 8% is very strong, other companies have performed a lot better, but over the last 5 and the last 10 years, this company has done extraordinarily well, massively outperforming the S&P, and again, even with Wall Street's strong buy rating, we want to focus on 4 under-the-radar AI stocks that will, again, some way or another benefit from the increase that is expected in the total addressable market surrounding data centers, but also artificial intelligence. Now, stock number 1 is Dell, and it might just be one of the most overlooked AI players in the market right now. Whilst most investors, as we highlighted, are chasing Nvidia or AMD, Dell is quietly building the backbone of the AI revolution. They partnered directly with Nvidia to launch what they're calling an AI factory, combining Dell servers and storage with Nvidia's cutting-edge chips to power enterprise-level AI. And it isn't just a PC company anymore, it's becoming a critical player in the AI data center boom, and it's a company that analysts love significantly, with a triple buy rating from Seeking Alpha, Wall Street and Quant. In fact, Wall Street 4.45, near the 4.5 to flip this into a strong buy, and it does currently trade in the mid to lower end of the 52-week range, down 16% over the last year. Year to date also down, but over the last 5 years it has significantly outperformed the S&P, where they're up 139%. Now we do however have to point out that in terms of what the valuation is, whilst it is fairly low at 11, and we will compare that to the sector, it isn't trading that far off the 5-year average, so you could argue this is one reasonable valuation signal, and that's also confirmed when we take a look at the blue tunnel methodology, which highlights the intrinsic price. 2 things. Firstly, we want to note, we like the fact the blue tunnel is increasing over time. That is always what you want to see with companies you're investing in or considering, but the stock price has been moving the other way, which can lead to opportunity. And whilst we have seen it around April during Liberation Day at severe undervaluation, as of now it does sit well inside the blue tunnel. That is again confirming the previous reasonable signal, and their valuation grade overall comes to a B-, but when we compare their forward P against the sector, you can see you are getting a 48% discount. Now we did highlight against their own 5-year average, you are paying a very minimal premium of 13%, but if you just want to think about this against others in the sector, you are getting a severe discount, one that we will come to and understand if in fact it is worth the current price. In terms of the growth, they do get a C+, year on year and forward looking around the 8% level, which is marginally above the sector. Interesting, because they're actually trading at quite a large discount to it, and against the 5-year average they're also growing their revenues much faster. We also notice EPS anticipated moving forwards 3 to 5 years, 13% year on year, pretty much in line with the sector, but also higher than their own historicals, so looking very good so far. We'll also flag that in their most recent quarter, revenue was up 5% year on year. Not the greatest in terms of growth, we have to be honest, as inflation we typically want to see at least 4% just to keep up in line, so only a marginal increase, and in terms of the margins, very minimal efficiencies, -1 on the gross, +1 on the operating, and flat on the bottom line. However, moving forwards over the next 4 quarters, they are anticipating double-digit growth, each one to the EPS, 75% track record, so 3 out of 4 beats against analyst target. They did, however, miss the most recent one by 14 cents and trading at their next full accounting period at a forward P of 10.4. Now before we get into our own intrinsic value, just to let you know, institutions hold 76% ownership. They sold around $4 billion in just the last year. However, they bought nearly twice as much, so clearly very bullish, and that is a trend we've seen in the most recent quarter in Q1, and actually you'd have to go to Q2 2024, so about a year ago, to see the reversal of the trend. So clear and obvious, institutions are fairly bullish. Now our intrinsic value gets to $150, which is the average of the 4 models that you see on screen, and typically when we do our deeper dives on this channel, we run through every single one of the models. Today we're running through 3 others, so let's get straight to it, where we always apply a margin of safety of 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $135, then we keep going till it's near the current trading price, and in essence, not a 30% MOS just yet. That would be a buy at 105. We see this around a 25%, with Wall Street themselves $138 into the next year, translating to 25% upside. Give us your thoughts. Dell Technologies, stock number 1, 25% MOS, 25% upside, buy, hold or sell. Just before we move on, we want to let you know we have released our latest free weekly article where we drop one every single Monday morning covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a copy of severely undervalued stocks for the month of June. Lots of information for each one, the upside that Wall Street themselves see over the next year, as well as a copy of 19 stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the second stock, which is Applied Materials, one of the most important companies in the entire semiconductor supply chain, yet most investors have no idea what it does. Now, Applied Materials, they effectively build the machine that make the chips, from AI processors to smartphone silicon, and with the AI boom pushing demand for more advanced chips, Applied Materials is set to benefit massively at every stage of the production. So if you believe as an investor in the future of artificial intelligence, Applied Materials is definitely one of the stocks you really need to consider in your overall portfolio, which could have significant upside and massive gains over the longer term. Now the stock itself is down 25% over the last year. Year to date they're up around 6%, and over the last 10 years they've massively outperformed the S&P, up 776%, but they are trading on quite a substantial dip from their 52 and all-time highs of $256, with both Wall Street and Seeking Alpha giving this a fairly respectable buy rating. However, we do notice the forward P pretty much in line with the 5-year average, so another reasonable signal, and that is also confirmed when we take a look at this model, pretty much sitting bang in the middle, again, reasonable signal confirmed. Now their valuation does get a D, however, when we look at their forward P in comparison to the sector, you are getting a 21% discount, and pretty much, as we note, trading in line with their average. That's very consistent no matter what metric you look at against their 5-year, but we can in fact note slightly different conclusion depending on what valuation metric you do like to use. Their growth does come in at a D+, but when we look year on year and forward looking, it sits around the 5 to 6%, not that far off the sector. However, what does let them down a little bit is that over the last 5 years, they have grown at a faster rate, and EPS is projected only 9% moving forwards, when the sector sits at 14 and their own 5-year around 12 to 13. Now their latest earnings did come at growth of 7% from the same quarter last year, with some efficiencies noted to their gross operating and 4 percentage points to their bottom line net income, and they expect 3 of the next 4 quarters to be growth. They have a 100% historical track record, trading on October 26 at a forward P of 17.1, and institutions hold 81% ownership, where they've sold $15 billion over the last year. They've bought a little bit more at 17, and the same to be seen in quarter 1, little bit more buying than selling from institutions, so marginally more bullish. Now our intrinsic value gets to $213, and remember, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for AMAT or any others, but at 213 and given the price at 171, you are getting a margin of safety bang on at the 20% level, whilst Wall Street themselves see this at 210 into 2026, indicating 23% upside. Applied Materials, 20% margin of safety, 23% upside. Buy, hold or sell. We then move on to Qualcomm, which is quietly becoming one of the biggest winners of the AI shift, not in data centers but also in your pocket. They're dominating the smartphone chip market, and now they're leading the push to bring artificial intelligence directly onto devices like phones, laptops, and even cars. With custom AI chips as well, strong relationships with Android makers, and a growing automotive business, Qualcomm is building a moat in on-device intelligence. This isn't just a 5G play anymore, and many analysts are very bullish about the future of Qualcomm in the AI process. Now, the company has suffered over the last 12 months, down 24%. Year to date, they're up 4%. Over the last 10, they have slightly outperformed the S&P, up 138, whilst trading towards the lower end of the 52-week range. A double buy from Seek Alpha as well as Wall Street, and this company does trade slightly lower than their 5-year average, whilst also offering a yield which is slightly above. There in turn, this is a potential undervaluation signal, one that when we take a look at this model also comes to a similar conclusion, as the share price is right there towards the bottom end, so this could be one out of the three so far that the initial signals are pointing to an opportunity. And in terms of the valuation grading, they get a C+. Now 13.6 is a lot lower than the sector, so you are getting a 41% discount, but as highlighted, also a discount to their 5-year. So on both accounts for Qualcomm, discount is noted. Now their growth does get a D-. We are seeing revenue year on year at 17%, forward looking at 7%, indicating that these companies and these industries are fairly cyclical. However, it is slightly above the sector median, yet when we look at their 5-year average, we can see a little bit of a difference. Now, one area that does give them the D- overall is the EPS, 7.3%, which is lower than the sector at 14 and their 5-year at 15. And in terms of their earnings, it was very strong actually, up 17% year on year. We noted small deficiency to their gross, but operating was up 3 and their bottom line up 1. And they expect 2 of the next 4 quarters to be growth, with a 100% historical track record, trading on September 26 at a forward P of 13.5. Now, institutions hold 74% ownership. We can see 14 billion worth of selling, 20 billion worth of buying, and more buying in Q1, so very obvious. And also, if we do keep going, you'd have to go quite some way to see the reversal of the trend. Very minimal difference in Q3, a lot more buying in Q2, and as you can see, pretty much Q2 of 2022 was where we saw a lot more selling by institutions. Now, intrinsic value gets to $201. You are getting a margin of safety, quite a large one at that as well, at least 20% up to 161. 151 at 25, not quite there yet, so sitting somewhere between 20 to 25. Wall Street themselves, $190 price target, 20% upside, could be one to consider, or at least on the watch list. We then move on to Lam Research, which is one of the most critical yet under the radar companies powering the AI boom. They make the advanced tools needed to manufacture the most cutting edge chips, especially for AI and high performance computing. As demand for more powerful semiconductors explode, Lam's etching and disposition machines are absolutely essential. So if you want to invest in the picks and shovels of the AI gold rush, Lam Research definitely needs to be on your watch list at the very bare minimum. Now, the company is down 9% over the last year. Year to date, they're up a strong 26%, and over the last 10 years, massive outperformance, up nearly 1,000%, S&P nowhere near, and they're trading around the midpoint of the 52-week range, with another double buy from Seek Alpha as well as Wall Street. Now, their forward P at 22 does sit above their 5-year at 20, so you could argue a slight potential overvaluation signal. But when we take a look at this methodology, we can see it is still within the blue tunnel parameters, so potentially a reasonably valued company. In terms of their grading, they get a D- because they're pretty much trading in line with the sector. However, they are trading at a 12% premium as highlighted against their own 5-year. That again remains the same conclusion. Premium, although very minimal, to their 5-year. depending on which metric you want to look at, you will come to a different conclusion against the sector. Growth does leave a little bit to be desired at a C-. Year on year was very strong at 20%, but again, industry is cyclical, expected around 3 moving forwards. Sector, as we've noted on the episode today, around the mid-single digit, but when we look at their 5-year average, we can see a little bit of a difference. Now, EPS projected 15%, which whilst it does get a C+, is above the sector at 13.5 and their 5-year at 13, and their latest earnings was very strong, top line up 24%, whilst also noticing efficiencies 2, 5 and 3 respectively on their margins. And over the next 4 quarters, they are projecting 3 of them to be growth, next one in fact 47%, whilst also having a 100% track record, trading on 2026 at a forward P of 22.6. Institutions holding 85% ownership, selling $3 billion over the last year, buying a massive $51 billion in the same time frame, whilst also buying twice as much in Q1 and a humongous buy in Q4. So very obvious here, institutions extremely bullish. Now, intrinsic value gets to $103, so this could be one of those with the least margin of safety today. At 10%, by $93. At 15%, not there yet, but not far off. So Lam Research somewhere between 10 to 15%, with Wall Street projecting into 2026 a price target of $100, indicating 11% upside. Now, for those that like Lam Research but want a larger MOS, if it gets there, as we said, 15%, buy at $87, at 20% at $82, and at 25%, $77. At the moment though, 10 to 15, upside of 11%, and you can always grab a copy of this model by clicking on the pinned comment below. So give us your thoughts about these 4 AI stocks, whether they're on your buy, hold or sell, or in fact even on the watch list. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.